All right, so the tale of two moves here this week. Starting off the week with a pretty significant bearish move, but then finishing the week with a pretty significant bullish move, an even bigger 4-day bullish move. So does that reverse things now? What we saw on Monday? That's the big question, especially from last Wednesday when you heard from me last to now. With two more up days, does that change things? What does the Russell look like over those 2 days, and how does that impact what we expect to see from a broader risk appetite trade and these other asset classes? Are they showing us risk appetite as well? Are they showing us risk aversion? So I'm going to break that down in our video today and kind of see what's really limiting the Russell 2000 from a technical standpoint relative to these large cap indexes. Why was it unable to finish the week as strongly as we saw the Qs and the SPX? And have we seen the Qs diverge like this away from IWM before? And what was the ramifications of that divergence? So I'm going to break all that down in today's video with a trade idea from the stock within that kind of tech space that is doing its own bullish move. And we'll talk about, okay, do we want to chase that, or is there a way to trade it? So let's go ahead and get started. Today is Friday, July the 23rd, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. Look at that 4-day rally. So started the week off with a negative, and then boom, 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 up to new highs on the S&P 500 here, hitting above 4,400 up to 4,415 before dialing it back a smidgen. The near-term line stayed at extremely bullish levels. Very, very high levels for the near-term line. The intermediate line, of course, is now rolling up because of it. And remember, the intermediate line never did dip below 40, so it still hasn't dipped below 40 for now, going on close to 9 months, because it doesn't look like it's going to dip below 40 like next week. So we still, we're going to be going towards the beginning of August by the time, if it starts, even if it starts to work its way down there now. Momentum line is actually still at that level. Again, that's the problem when you have the gaps like we've been seeing here. You don't get the big ranges during the day. We'll take a look at that gap here in just a second. Of course, it's all fueled by what's going on in the NASDAQ. Big move in the NASDAQ the last 4 days. Same pattern that you're seeing here, except its intermediate line is above 80. And keep in mind, the NASDAQ did have 2 declines of the intermediate line getting below 40. So we've had 2 pullbacks, intermediate pullbacks, since November that we haven't seen on the S&P 500. And of course, we are currently in a pullback on the Russell 2000. You notice its rally today wasn't nearly as much, and it didn't get us up to new highs. It didn't even get us up to new weekly, intra-week highs, as we're still down below the Wednesday close and just barely above where we closed yesterday. Its intermediate line still below 40, so actually in intermediate mode, obviously coming off the cluster that we saw on Monday, but not getting above resistance. And that's the problem you're seeing with the Russell 2000 right now. Let's take a look at the weekly market forecast. So let's come over here. And now you see a big, strong momentum line, because that's a very strong move. Big range this week, 182 points coming off of 71 last week, and 82 the week before that, and 80 the week before that, and 112 the week before that. And this is a tremendous range this week. That's why you have, and you close at the high of the range. So that's why you have this momentum line as high as it is. Of course, the near-term line didn't move up, so it's actually still, but at least it is above 70. So again, not a cluster, but pretty darn close to a cluster. Again, very strong move on the S&P 500. But now let's take a look at the Russell 2000's market forecast chart. And you can see, of course, that near-term line is in opposite direction. It's down below 40, the lowest near-term level we've had since this decline that we had on the Russell, the last intermediate decline that the S&P had, right, where everything fell, right? So, which, again, during an intermediate pullback, everything goes down, right? That's when correlations get close to 100%. Like the NASDAQ's had one, the Russell's had one, the Dow even had a smidgen of one, but the S&P hasn't, because not everything has gone down. We've seen that the sectors aren't lining up with each other. Until they do, that's when you have a risk-off moment or risk aversion trade going on. The whole asset class is treated equally instead of the rotation that you see that's going on right now. It's just an extension of a mature bullish market. Because in early bullish runs, everything goes up, right? If everything goes down, everything bounces back up. Just to different degrees. Now, you don't even have everything going up or down at the same time. You have some going up, some actually going down. So that's why it's like very much of a sign of a mature, especially a mature market sentiment rally. You start to see those kind of rotations at the end of long-term moves, market sentiment moves. In this case, they move off the COVID low, which would be, two intermediate rallies put together, sandwiched around that intermediate pullback in last September, October. But again, that's the week. So we actually have light pink shading in the yellow line. That's the first time we've had that. Now, granted, that can be a bullish pattern, as we just saw in the S&P on its daily chart. So that in and of itself can be a bullish sign. We'll kind of keep our eyes on that because we did get an extreme low on the momentum line last week, and we bounced off of that. The momentum line bounced, and that kept the near-term line from following into that level. So the momentum line did come out of the bearish territory, but just barely. So it's going to be a very important week next week that we bounce back up here, up above that 30-day moving average, and for that matter, also get back up above. If I were to look at this chart on a weekly basis here, weekly chart, you can see again we've been converging for so long on the Russell 2000 that we have finally broken. As we've converged, and we finally broke the 30-day moving average and the 17-day moving average, and now you can see we're still below it. So this happens, like when you converge for long periods of time, once you break, then that typically is your market sentiment decline. So it's, if you break down while you're still got a high MACD, it's a different story. But if you've been converging for so long, and then you break down below the 17 and the 30 at the same time, that is when you're like, okay, there's a good chance that this is actually the change, or the MACD in this case, on the weekly chart would actually go below zero. And again, not the levels of that fast, but something more like this. This wasn't the last market sentiment decline that we had in the broader markets as a whole. But you can see here on IWM as well, that wasn't obviously COVID related. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us two things. Number one, you liked our video today. And number two, you want us to do another video again on Monday. It's a quick way to give us feedback. Lets us know you like our videos. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch them. But if you do and you want to let us know, one click goes a long way. You can even do that right now while you're watching. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Post those in the comment section. Those go a long way for us as well, too. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. All of our free subscribers do get a unique offer for you. So to see what that offer is, subscribe to our site there. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching our videos, if you're watching his channel blog, check out some of these other things over here on the right. This is our Market Outlook live video. This is where I review all the Market Outlook trades that we do. And I also put on today's trade idea before the market closed. So if you want to see what that is before the market closes, instead of waiting until the next day, you can check that out there. Also, I get a lot of people asking me, hey, are you still in that trade? Or can we see you? Can you talk about that trade that you did and see what we still do? I do that every time I do the Market Outlook. I do that during this video. So the way you get to it is by clicking on this image here, or you can come mouse over Market Outlook, click on Market Outlook Live Trade Review. All of our paid subscribers get access to all of our trading rooms, as well as our live trade review videos. Of course, our premium subscribers also get access to Q&A sessions too, one from each of us during each week, as well as our access to our class forums and all of our premium subscribers. And they actually pay less per month than what our monthly subscribers do. Come down here to the bottom for all of that, right? And come down here to the bottom click on that heart. It opens up a new tab. Hit that like button there. Click on this thumbs up icon. It opens up another new tab. Click on that like button there. Again, the more you do that, it really helps us out because it gets our content out to more people who actually follow us. That's how these algorithms work. So we really appreciate everyone who hits those like buttons. You can do, like I said, you can do it right now while you're watching. Also, it helps you out because Facebook and Twitter will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's take a look at some of these other charts. Let's take a look at this weekly chart and look at that transition candle. Now, transition candles can take on two forms, right? They can either, when you look at them, they can either be bullish or bearish. That's not a bearish candle, right? So that's a pretty significant transition Hakinyashi, but not the bullish kinds or bearish kinds. So at best, or worse, I think we get another transition candle next week. But again, that's like worst case scenario, as you're going to start off with a pretty bullish candle since we're closing the week near the highs, and the open will be right about where my cursor is. So that's why I say it's not a transition to a bearish candle here. So we very well could get a transition candle again next week. Otherwise, we're back to bullish candles. But again, very, very high PPO, very strong trend, very strong momentum. No red arrow here, not like what we're seeing on the Russell. That's a vastly different story, what we're seeing on the Russell here. We're going to start off, next week's body is going to open up right around 2216. We're trading right now at 2209. So next week's candle for the Russell, if it doesn't turn out to be a bearish week for the small caps, could also be a transition candle back to bullish, right? So we can ride a new wave up to the upper end of this noisy range between 0 and 23%. And again, its PPO is actually still higher than the S&P. So as crazy bullish as the S&P seems right now, the Russell is actually more bullish, right? There's a bigger gap between the 50 and the 200-day moving average, just barely, but there's a bigger gap. But that gap is actually shrunk by more than half to get to that point. So again, it just goes to show how extremely bullish the Russell was and why it needed to consolidate that extreme moves, and why whenever you do get extreme moves like this in stocks, you either can tank or you have to consolidate. It's hard to maintain. In fact, it's impossible to maintain that kind of a move at that rate, right? You tend to slow, even if you still go up, you tend to really slow down the pace. If you take a look at the 3 green arrow charts for the S&P, you can see we're back to 3 green arrows now with the MACD turning back up. Let me show you what that looks like here. The MACD is back above its moving average. It's not very far above its moving average, and obviously we're not getting new highs, even though we are getting higher highs already here. I mean, we are setting up for divergence, just like that, on the MACD and stochastics. The question will be whether we'll get a new high. Like, you know, we went from this extreme high point here to a divergent high point to a new higher high. So we'll see if that ends up being the case. For SPY, obviously was not the case for the IWM. We got a lower high, and then now, and not only would it be a lower high point, but it would be a much lower high point. Its stochastics is flirting with getting out of the bearish territory here, even though its average is still stuck way down here. And you can see we did finish the week above its 8-day exponential moving average, but still below the 17-day. Breaking above the 17-day is that sign that we're reversing this move. If you take a look at some of these other oscillating charts, your SPX, you can see the divergence showing up on the RSI as well. The Russell 2000 is in the lower half of the chart, bearish territory. It's still below 0 in the CCI, so you see the big discrepancy there. Let's take a look at the directional movement index. You're not, and again, SPY, you're above 30 on the positive indicators. That's what's great, but you're not below 20 on the negative. You're actually just barely crossing below 25. So SPY doesn't look nearly as positive as what you're seeing on the Qs, which is really close to dropping below 20, and its positive index is hitting really high levels, like extremely high. Like that was our topic of our technical analysis class today, about identifying parabolic moves and then how to trade those, and with how to scan for those. Let's take a look at IWM, and you can see a much different story. Its negative indicators above 30. Its positive indicators actually back down below 20. And its ADX is pink, right? So it's actually in bearish mode. So much different situation here, and you see that in the trend strength indicators too. For the Qs, you're in extreme bullish moves. SPY is trying to get there, right? It's at 82 and 4.7. 5 and 80 are the key numbers, so it's almost there. And then IWM, you notice, is in a this would be a levels. This is the flip side of the bullish levels that we look for on the bearish side. So we're below -2 and we're above 65. That means we're on a bearish trend. The green line's easily below the blue line, and the price is back below the blue line. So now the question will be whether we get back below the green, as well as that 8-day exponential moving average next week, and continue the trend or not, or if we'll break this, right, and bounce through the cloud to get back up into the upper half of this noisy level. So very important resistance levels. You can see it here as well. IWM has a very, very important resistance level, and that's actually, in my opinion, what's going to keep us there. Not only do you have the moving average in between, and so you're still stuck in the lower half of the bandwidth, but that significant volume node is just going to weigh us down and keep us down. You don't have that issue on the Qs. You're actually breaking out well above the value area with the volume support actually below you, not above us. The volume node, excuse me, and a significant breakthrough. In fact, if you take a look, not only are you breaking up above, sorry, not that one. Not only are you breaking up above the Keltner channel, but you're also breaking above, or the Bollinger Band, but you're also breaking back up above the Keltner channel, with the band still outside of the Keltner channels, the Bollinger Band. So, again, you tend to trade when you get in that situation where you're bullish and you're trading outside the Keltner channels and the bands are outside the channels, and you end up trading in between when you have a good bullish trend going. And that potentially could be the case here if we rally back up. If you look at IWM, you can see we are actually doing the opposite. And now we're back up, we're back in the Keltner channels. Now the question will be whether we stay there or not, as the bands are still outside of the channels. But breaking through that moving average and breaking through that volume node will be significant next week. Otherwise, expect more bearishness. And again, I believe the bearishness on the Russell, the pullback we're already seeing here, will end if we break through that volume node, right? So that will be over with, and it will follow the Qs up for however long we'll continue this mature trend. Otherwise, if the Russell breaks this dam here at 212-ish, if it breaks through that level of support where there just is no volume down there, and you can especially see it on the 2-year chart when I bring in the COVID move and the pre-COVID move. I mean, there's no volume below this line. So if we break through there, that's when I think the rest of the market will go down with it. Then it will be your intermediate pullback where everything is pulling back. And you have a broad risk aversion trade instead of a narrow risk aversion that's only linked to just very specific segments in the market, in this case small cap, in the case of the Russell 2000. Alright, now let's take a look at the intraday moves, and look at that. I mean, look at the gap up today. Again, another common gap. We had a couple that we haven't filled in. We still have Wednesday's common gap that we haven't filled in yet on SPY. So that's looming, right? And we kind of saw a couple of these kind of gaps from over here, right, on the 25th and on the 29th, and probably even a little bit more below that. In fact, let me see where it was over here. Yeah, so you had this one here on the 24th and then the 25th, and it looked like we'd never fill those in, right? Then we had a couple of gaps over here that eventually got filled in pretty quickly with that drop on July 8th. And then he's like, oh, well, these gaps will never get filled in. Well, the longer you go without filling it in, the faster they get filled in. And that, it happened in just about one day there. We filled in all those gaps. So just because, we might not fill these gaps in even next week, but they are this one right here and then this one. But they are still common gaps, and you still would expect that they will get filled in. And again, the longer we go without it, the bigger the faster we will fill it in, like the bigger the drop to get to that point. So this is something to keep an eye on for next week. Of course, with IWM, not an issue, right? We already filled in the gap. We already filled in that gap. So, I mean, we filled in all these. There's no gaps that we haven't filled in. And you can see, again, even on the 90-day chart, why it's going to be hard for the Russell to get going because there's significant resistance there. If I go back to just the 20-day chart here, you can see, again, this is why we're stuck here too. Like, this is the volume node where we're at. So it's going to be really hard for the IWM to get through that. It doesn't mean it can't, right? It's not 0% odds that we'll get through there, but you can see why we're stuck here. And potentially it could fall down here because, again, go out to that 90-day time frame. If you go out to this 90-day time frame, again, there's more volume above us than below us. So the path of least resistance is to the downside. So it acts kind of like as a vacuum pulling you down instead of up where there's significant volume. Again, if you have enough momentum to get through it, you can. But if you're just kind of following the trend, then the path of least resistance is to the downside. Let's take a look at today's volume and trading range. 63 million. The volume, you remember, was 3.5 points, but with a gap there. So we closed 435.46. The low 436. So just over a point, about 1.25 points. So you're looking at about a 4 3/4 point move today. So when you look at that in context, 4 3/4 points is right about there, so above the line. And then the volume at 66 million also above here. Now this, you can see things are still rising. Like, this bullish move is still giving us bearish ranges and volumes. And then when you look at the volatility index, this is what's interesting to me. Big extreme low. Like, this looks like extreme lows here. But this is kind of, when I look at the seasonality chart, which is a line chart for the VIX, obviously we're headed into a seasonally bullish range for volatility over the last 20 years on average. But look at, this is the low point we're just getting, and here's the drops on the VIX, and you can see it appears that we hit our low point on the VIX in early July, and we're forming higher highs and higher lows. So considering that we just dropped down to a, considering we're still getting strong volumes and ranges, and that we just dropped down to this extreme low, and we are getting these types of, these pretty significant bearish opening gaps. When we do get the bearish gaps, they're pretty significant. You see, we don't get those when you're in bullish markets, but you tend to get more of them as we start to transition towards what could be a bearish market. Obviously, in IWM, we are in bearish pullback, and you can see it makes sense that we'd be getting these with all these 1% declines. But SPY we haven't been. So the fact that we've got a couple, and we've had, relatively a couple bearish closes, that's not that big of a deal. But it's the fact that we have had a few, and the fact that also too that VIX is at such an extreme low, but forming higher lows on a closing basis suggests, things. It'll be interesting to see how things go through next week. It's a big earnings week, I know, with FANG stocks. So that's going to have an impact on whether or not volatility stays really extremely bearish, and whether we continue to grind to the upside, or whether or not we spark some kind of catalyst next week or not. Fed will be, there'll be some chatter next week too from the Fed on that can influence the markets. With the FOMC meeting, I believe Wednesday. So we'll see how that, there's going to be kind of a tug of war there. We'll see if that ends up being a catalyst or not, and sparks us into, again, a seasonally time of year for volatility to be bullish, that we're going into at extremes, extreme lows, and not just extreme lows, but also a bullish, not that one, extreme lows, but also a bullish trend going into, coming off an extreme low with a bullish trend there. All right, so I'm going to break down how these different asset classes are performing and show you our trade idea of the day. But before I do that, to summarize the technical outlook, obviously we had a really good bounce back from Monday's decline, especially in the Qs. But again, that discrepancy between the Qs, pretty much, and not just everything in the Qs really, it's pretty much just the FANG stocks, Microsoft included, are your biggest winners and your biggest deviators from what everything else. So big divergences showing up on those particular indexes and what we're seeing with other risk asset classes, especially the Russell 2000, which is in pullback mode and is knocking on the door of opening the floodgates to where it's a broader risk aversion trade. So that's kind of where I'm thinking. I think there's a good chance that we might be headed more that direction by next week as we head into a seasonally bullish time of year for volatility to start to pick up. Right, especially going into it with that as extremely low as it currently is on a relative basis. So that sets us up for a bounce in volatility next week, and we got a lot of things that could produce it coming out, but a lot of things too that could just keep us grinding to the upside and keep volatility extremely low. So I tend to lean more towards the former rather than the latter, but it doesn't mean that I don't have any trades to take advantage of the latter, as most of the market scholars know the types of trades that we do in our trading rooms to be able to still take advantage of the trend and still be aware of the possibility of pullbacks and be hedged for that type of situation. So what do you think? Do you agree with that? Do you disagree with that technical outlook? Let me know in the comment section below, especially if you disagree. What charts or indicators are you looking at that suggest why either you're a lot more bullish than I am or a lot more bearish than I am? All right, now let's take a look at what's driving the price action. You can see, I mean, this is the commodities are bouncing. This is a 3-month chart. Commodities are doing well. Real estate's doing well. QQQ is doing well as a safe haven trade. But that's it, right? The international stocks are doing poorly. IWM is doing poorly. If I were to go all the way back out to when small caps peaked relative to the NASDAQ up until now, you can see the NASDAQ is at its peak, up 17% almost since that March 15th high. Small cap stocks are actually down 6%. That is a wide gap. Bonds are up during this time frame, almost outpacing stocks. I've been kind of going back and forth here lately with stocks. Gold is up, the dollar is up, foreign bonds are up. Everything else is lagging, and so especially emerging markets and the commodities are kind of holding up as well. But you can see it's like, since that March 15th time frame, it's really been a 5-horse race. And those are the horses that are really keeping risk appetite alive right now, because from a broader standpoint, risk appetite appears to be on the wane. Let's take a look at the dollar because that's a big factor. And look how the dollar finished the week. And you can see it finished the week on a rise. The dollar's continuing to rise, but you notice its rise is really slowing because we're really converging. When you look at this chart here, we've already peaked on the MACD, and we peaked on a histogram. We peaked on the MACD. We've started to converge. We're still trading below the 8-day moving average, and we haven't flipped back around. Of course, if and when we do flip back around, that will be a true risk-on mode. So that will be a reflection of a broader risk appetite trade. Obviously, we're not to that point yet. We're still in this risk aversion mode, trading below and trending down at a slowing pace, but trending down below support. And you can see a very similar move going on long-term bonds. Another risk appetite trade, as bullish as it is. Obviously, the MACD appears to have peaked. The MACD itself appears to have peaked here. We got a little bit of an engulfing pattern coming out of Monday's jump to the upside, but we're still up above the 17-day moving average. We've come down and tested it a few times, but every time we come down and test, we jump up to new highs. Again, this is a risk aversion trade, not a risk appetite trade. You take a look at gold with a strengthening dollar. You can see gold has been bearish with initially on the strength of the dollar, but as the dollar continued to go down, or go up, gold has started to go up itself and is flirting with this move of a change in direction here from a bearish direction to a bullish one. And then with if you have that with the dollar kind of holding its strength and gold moving up and bonds moving up, then we know, again, broader risk off trade. We already know what EEM looks like, or IWM looks like. Here's what EEM looks like. So very bearish move. Obviously, China has a big influence on this, but a very bearish move and a big divergence to the downside here. And you can see that the long-term charts for EEM is to the point where we're getting the EEM here is getting close, like we're flirted. It's almost like exactly like the Russell, big time rally. Remember, 8% is where the S&P is, so all the way up to 11-12%, and then the consolidation, and we're trading below. You got a red arrow, so we're in intermediate pullback mode, and we're trading below a 50-day moving average, moving down. EFA has kind of been in that mode too, but kind of doing a little bit slower. In fact, if you look at the major global markets here, represented by their ETFs, you can just see how bearish China and Brazil and Korea are. And then everything else just looks light green shading and red lines. So we're below these moving averages. That's when you get your biggest bullish moves, right? When you're below moving averages. The question is whether or not we'll get through these moving averages, or if we'll hold these for resistance and roll back over. That's going to be the big question mark going into next week. I expect that we'll hit resistance, because I expect resistance to hold until it doesn't. So definitely a big divergence to SPX, which you can see is kind of doing its own thing over here in the top left corner. Again, not the broadest sense of a risk appetite trade. And if I were to do the same thing with the US sectors and how they're doing, you can see what's driving this risk on move. I mean, look at that jump in XLC going into next week, and XLK and XLY looking very strong, and everything else not really. I mean, they had a good week here, because again, you tend to get your biggest moves when you're below the moving average, especially the further below the moving average you are. But they're not big enough moves necessarily to change things around. You are back to dark green shading and a green line on industrials, but not on these others. And healthcare is looking a lot like these cyclical areas up here at the top right now. Everything else sideways at best, and converging for real estate. So you can see it's a very specific segment of the market that is driving this bullish sentiment and appetite, and this happens to be the segment that has the largest market cap weighting within these market cap weighted indexes. And that's why we're so strongly bullish still in the Qs, where they have the biggest weighting, and the S&P, where they also have large weighting, and not so bullish in some of the other indexes, like we've showed before in other parts of the world, as well as in small cap stocks. In fact, if you look at the rotation graph for small cap stocks, we'll come back to the trend here in just a second. And this is the rotation graph. You can see small caps and value, which has been the growth areas here lately, because they've really, they outperformed big time coming into. You can see coming off of the lows, they weren't doing so well. There's small caps. They're not doing so well during the sell-off, so they fell the most. But then during the rally, they started to gain some momentum, but then they rolled over, right? So you can see there's the rollover there. But then, as we started to pick back up again, coming off of this low point, you can see small caps and mid caps made a really good run to the upside, up to the top right, but have since started to slow down, losing some momentum, and now moving down to the left as large cap growth moves up to the right and shows you a little bit of a safe haven area. And you can see that here, and a little bit of a parabolic move that we're getting right now on this chart that if I look at this, the PPO here for that MACD right about 2%. That's a relatively high level, and last time we had that level on a bullish move like this that we're getting, where the Qs went parabolic, was September, and that preceded a risk-off move. Now, I don't think that we'll get another decline like this, because that risk-off move turned into the new bullish leg led higher by these small caps. I think the next bullish leg will be led higher by large caps, but I think there'll be a little bit of a risk-off move where you get a little bit of a discrepancy and a little turn down, like we started to there, get a little turn down, and then when we rally back up, I expect that this chart will actually make it back above 2 by the time all is said and done, when this bull market ultimately transitions into a long-term bear market, not a one-day bear market like everyone wants to paint all these dips as, like we had on Monday. What's interesting about this little rally we had to close off the week, very, very strong rally, but the trend finished at its highest level that it's finished in a long time. In fact, usually when you're at these high levels, you're on declines, not rallies. So interesting that we finished the week on an extreme high level, which means there was more declining volume than advancing volume relative to the decliners to advancers ratio. So fewer advancers, more decliners, more declining volume in a larger scale, even more than what we saw in the advancing volume, to a large degree. And in fact, when you look at the gamma exposure, instead of rising like we've seen before when we hit these extreme levels going into expiration, we started the decline. We actually are very, very, low levels, which means you're not seeing a lot of call buying on this rally, and we're seeing a lot of declining volume, large amounts of declining volume relative to advancing volume when you compare it to the advancers versus decliners ratio. So it kind of shows that this little rally that we got to push us up so high to these divergent high points to extreme lows and volatility may not be as bullish as it appears under the surface. Let's take a look at our trade idea of the day. I wanted to take a look here at Etsy. So let me pull up Etsy here really quick. Etsy. Here is Etsy. You can see it's doing its own little thing. It's got a nice, good bullish move going here. But the problem with what I see on Etsy is we've got this strong volume above the value area, mind you, but a strong volume node. It's not the point of control because that's way down here, but and the next point of control is going to be right around this 170 level. But it is a strong volume stuck in this area. We've been stuck here before. We're getting back to that mode again, heading into an earnings announcement, which the last time it actually sparked a big drop and then no move. And before that we sparked a big upward move and then no move. So the last time we had a big earnings announcement on this particular quarter, it didn't go anywhere. When you got a lot of volume in this area and we're trading right at that volume node, and then you look at some other indicators like the directional movement index, and you can see, you got a bullish directional move but a very low ADX. When you look at the RSI and the CCI, you got a bullish directional move here, almost above 200, almost to 70, it looks like to a new higher high point there. You take a look at the Ichimoku trend, and you see we're above the cloud, but we are forming just a very weak bullish move. So we're not getting a strong bullish trend. We're not breaking into a gap area, very little volume. In fact, we're breaking to a gap area where there's a lot of volume, which opens up for me the opportunity to do this iron condor spread. So if I sell the 20 deltas and buy the 250 to protect it, so sell the 20 delta over here, go $10 out to protect it on that side. You notice it's a $10 wide spread, so I can only do one contract because my normal risk is $1,000 on these trades. But my normal gain is $300 on these trades. And you notice I can get that for a lot less than $1,000 of risk. In fact, less than $700 of risk because of the earnings announcement it has coming out. So when I sell that iron condor, then you notice these break-evens on the chart end up being at that low point, which is a very good spot to have a break-even on the downside. And if we are going to get a little bit of a breakout move, it's probably going to be to the upside. And I've got plenty of room to work with my break-even up there to the upside. So we can go all the way up. In fact, one standard deviation move to the upside is actually inside of the break-even, and you've got that old resistance, the old high that it touched over there. So, and of course the volume node that will kind of keep us in this area, that can try to keep us in this area. So that's kind of the basis for that trade, this kind of a bullish breakout trade. So I'm not as worried about the downside, more worried about the upside, but I've got a lot of room to work with to the upside. Alright, that does it for me today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. All of our subscribers, even our free subscribers, have access to that forum. So open up any new threads with any questions or comments you have. Reply to other people's threads with their questions or comments. And let's keep this conversation going in between videos. As always, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Like us on Twitter and Facebook as well. Comment on the video. Have a great rest of your weekend, everybody. And we'll see you all next time.